How much will my retirement pot get me as an income? We're all looking for a definitive answer to that question. Assuming you're not ready to fix your income for life with an annuity just yet, there are different methods you can use for selecting your level of withdrawal. One would be to work out the average expected return from a portfolio and to take that on an annual basis. Another would be to adopt the well-known 4% rule, where you simply withdraw 4% of your plan's initial value every year, increasing it in line with inflation. Well, in this video, I'm going to take 3 different retirement pots and show you, using historical data, how both of those methods will fail you more often than you might think. I'll then show you exactly what could be considered a sustainable withdrawal rate and the strategies you can adopt to increase your withdrawals over time. If you've landed here for the first time, I'm Chris Bourne, and for the past 17 years as a financial planner, I've specialised in helping people achieve tax-efficient financial independence. My videos are designed to give you the tools to do just that. Subscribe if that's for you, turn on your notifications so you don't miss a video, and without further ado, let's get into it. If you're close to retirement, or even if you've allowed your mind to wander towards the future, you've probably asked yourself what sort of income your retirement pot might generate for you. You might have even landed on this video because you've asked that very question. And the reason it's such a commonly searched topic is because nobody seems to be able to provide a direct answer. There are just a number of popular methods, with various sites extolling the virtues of one over the other. This is a problem because it means that people are often left confused about whether they've got enough or how much enough is. That can lead to you being too scared to actually take the step into retirement, or worse than that, thinking you've got enough when you probably haven't. Well, to give you a more detailed answer to the question of how much will my pension be able to pay me, I'm going to use Voyant's cash flow modelling software to test some common withdrawal strategies. I'll be testing them against different fund sizes to demonstrate the likelihood of your money lasting for life. Voyant is what I use with all of my clients to create financial plans. But first, what assumptions are we using to test how long a retirement pot will last? Well, in the first scenario, we'll look at income from a pot of £100,000, and then we'll look at pots of 250k and 500k. We'll assume you're starting income withdrawals at age 55 and that you'll live until 95, so 40 years. We'll say the underlying split of investments you hold is 60% in global stocks and 40% in global fixed income, which historically, since 1926, would have given you about an 8% average annual return. You can see here as well what the best and worst years have been in those asset classes over that time period. Finally, we'll assume that the money is held in a pension environment because that's the most likely place people will hold their retirement pots. The withdrawal amounts shown are all before tax, and we'll estimate costs and charges of 1% a year. So with our £100,000 pension pot, what's the maximum income we'd be able to successfully take every year if we were to withdraw the average growth rate? And by successfully, I mean for us not to run out of money during the 40-year period. Well, fortunately, Voyant is able to provide this insight to us and calculate exactly how much we could take out every year on that basis. And as we can see here, that amount would be £5,869. Now you might be saying, hold on a second, if the average growth rate has been 8%, surely I could take £8,000 a year from a £100,000 pot. Well, the reason it's lower is because of inflation. What we're being shown is the amount you could take out every year if you were to annually increase your withdrawal by 2%, which is the Bank of England's inflation target. Effectively, it's £5,869 of spending power every year in today's terms. We can see here that at age 80, the withdrawal would actually be £9,629, but that would buy you the same as £5,869 would today, assuming 2% inflation. So this would suggest that if investment returns continue to be the same going forward as they have been in the past, you should be able to take this £5,869 every year, increase it by 2% every year, and never run out of money. But how true is that? If we were to run what's called a Monte Carlo simulation, it reveals some pretty interesting information. What this analysis does is stress test the plan to provide a probability of success. And I'll explain how in just a moment. But by telling Voyant that we plan on taking £5,869, increasing by 2% a year, it tells us that our probability of success is just 40%. it's more likely that this approach will fail than succeed. So why is that? Well, the reason is because the average return isn't actually what you get every year. Your success or failure has everything to do with your sequence of returns. And that's what we refer to as sequencing risk. What do you think would happen if you knew that the long-term average return on a portfolio was going to be 8%, so you decided to draw that amount out, but actually over the first few years the performance was terrible, and only after then did it start picking up and bringing the performance up to the average? Do you think you'd have the same amount of capital as you would if you were actually getting the average of 8% a year? Well, I can tell you that you wouldn't, and unfortunately taking that money out will have done irreparable damage to your pot, because 8% average growth going forward would no longer be enough to bring your plan value anywhere close to what it was originally. And this is what the analysis is showing us. What it's doing is using historic data about the volatility of investments to project a range of possible outcomes. Both equities and fixed income have an expected volatility range based on all of the long-term returns we've seen. Remember, I showed you the highest and lowest returns earlier. For equities, i.e. stocks, that volatility range is around 19%. And for fixed income, i.e. bonds, it's around 3%. We call this measure of volatility standard deviation. What it's simply designed to do is give us a good idea of the range of returns we're likely to see each year by telling us how much the return should fluctuate around the mean average. So for example, if the average equity return was 10% a year, standard deviation would suggest that your return should be somewhere between 29% and minus 9%. If the average fixed income return was 5%, you'd expect a range between 8% and 2%. Statistically, we know that returns are within one standard deviation 68% of the time. We know they're within two standard deviations 95% of the time, and within three, 99.7% of the time. Now, Voyant is also clever enough to work out returns of asset classes in relation to each other. So if the returns on equities are negative, what does history tell us about the likely returns on fixed income? It's what's called a Cholesky decomposition. It's very complex mathematics that fortunately we don't have to perform ourselves. That's the value of advanced cash flow modelling software. So taking this back to the Monte Carlo analysis, what it does is randomise hundreds or even thousands of investment return sequences within these ranges to tell us how likely we are to succeed. The purple dotted line shows what would happen if we did get the average return, but the top and bottom of the lighter purple shading indicate the highly probable best and worst case scenarios. And that range of probabilities widens greatly as time goes by. Whereas at the start your 100k could be worth anywhere between 69,000 and 137,000 after you've taken your first year's income out, it could be anything between 0 and 2.8 million at the end. But most importantly, it illustrates that as time goes by, the likelihood of you actually running out of money becomes greater and greater. We can never be 100% certain of anything. But with financial planning, what we're aiming to do is eliminate as much risk as possible and increase probabilities as high as possible. And unfortunately, a 40% probability isn't high enough to have confidence at all. So what about the much lauded 4% rule then? If you've consumed financial content for any length of time, or you're aware of the FIRE movement, you'll definitely have come across this. Quite simply, the 4% rule states that drawing 4% of your initial capital and increasing that withdrawal each year in line with inflation is a safe strategy, because back-tested over historic time periods, you've got a very high probability of success, well over 95%. Well, let's test it, shall we? Changing the initial withdrawal level to 4% and running the Monte Carlo simulation again tells us that we now have a success probability of 77%. A big improvement, but certainly not over 95%. And plenty of room for uncertainty. The reason for this is that the study on which the 4% rule was originally based only assessed a retirement period of 30 years. We're looking at 40 years here, which certainly isn't unrealistic these days. Also, the original study only looked at US stock market data, whereas we're looking at global stock market data. The US has been the strongest performing market long term, but There's no guarantee that will always be the case. So taking all of this into account, what would be a safe level of withdrawal? Well, in my personal opinion, I don't think we need to aim for 100% certainty. There's no such thing as that anyway. But on the basis that at age 80, under the 4% withdrawal scenario, the average return would have seen your 100k grow to over 269,000, and the best case scenario would put it at over 2 million, there's no need to go ultra cautious. I work on the basis that around a 95% degree of certainty is enough for confidence, especially as we'd also aim to have a cash buffer in retirement of probably around 2 to 3 years worth of withdrawals to be called upon in extreme circumstances. If we were to require a 95% degree of certainty, an initial withdrawal of roughly £3,000 a year, increasing annually by 2%, would give us this. Cash flow modelling is all about confidence, and that's what a system like Voyant aims to give you. I will actually be creating a course to teach you how to use Voyant yourself to create your own financial plan, which will of course include a full license to access the software. Let me know in the comments if that's something you're interested in, and make sure you sign up to my mailing list in the description to stay informed. To summarise so far then, we've worked out that a sustainable withdrawal rate on a £100,000 pot would be £3,000 a year initially, increasing by 2% a year, if you wanted to have a 95% degree of certainty that you won't run out of money over 40 years. So what would the different figures be if you had a 250k pot and a 500k pot? Well, the maximum return on 250k of retirement savings would be £14,385, and that would give you a 35% probability of success. A 4% starting withdrawal of £10,000 a year would give you a 77% chance of success. And to gain around a 95% degree of certainty, your starting withdrawal level would have to be £7,300. For 500k, the maximum inflation adjusted withdrawal was calculated at £27,646 with a 33% success rate. A starting withdrawal of £20,000 gave a 71% probability of success, and £14,300 was the starting withdrawal level that gave a 95% chance of success. The theme that we can see here, of course, is that the sustainable withdrawal rate is much closer to 3% than it is 4%. So how can we improve these? Well, one way would be to shorten the retirement. If we assume that retirement was 35 years instead of 40, so you retired at 60 instead, the sustainable withdrawal level increases to £3,300 for 100k, £7,900 for 250k, and £15,100 for 500k. If retirement was 30 years, they increase to £3,700, £8,800 and £16,900. Interestingly though, still not quite 4%. Another way, going back to taking retirement at age 55, would be to assume that withdrawals are decreased by around a quarter when you reach, say, age 75. This is what I tend to observe in people's retirements. They start to spend less from their mid-70s onwards because they become less active. So why not plan that in to see how much it can increase your starting withdrawal levels? We can see on screen now how much of a difference that makes across the board. The sustainable starting withdrawal levels are all higher, and the initial withdrawal percentages these translate into are all displayed as well. One thing that doesn't markedly improve your probability of success though is increasing the investment risk on your portfolio, contrary to popular belief. What I mean by that is changing your portfolio allocation to hold, let's say, 70% equities instead of 60% in order to access the higher returns equities can provide has very little impact on the probability of success. All it does is increase the highest and the average return potentials. There is a balance to be struck, of course. 100% invested in equities will probably produce a much better result than 100% in cash. But there is such a thing as an optimum split of assets before you start to lose the reward for taking on additional risk. Just a couple of other considerations to take into account when working out how much income you can take are that regular reviews are essential. It's very unlikely that the income you start taking will be, or should be, the income you continue to draw throughout retirement. We may well start out by assessing income suitability with the stress tests described in this video, But let's say your returns were better than expected or worse than expected initially. We should have a rules-based system for dealing with this when reviewing our income annually, whether this be by increasing our cash buffer or using a dynamic spending approach, something I'll cover in more detail in a future video. Let's also not forget that although they've been out of favour for a long time, annuities shouldn't be forgotten forever, particularly if rates continue to improve as they have been. It is possible to take all risk away from your income and to guarantee it for life. If it is income that's the most important thing to you, rather than leaving the legacy of a pension pot to someone else, an annuity can be appropriate, particularly as you get older. You might only get £4,913 on a 100k annuity purchase at 55, you see, but it would be £8,054 at age 75 based on current rates. There are of course other considerations when purchasing annuities, and certainly a loss of flexibility, but it's a reminder that they do still exist. For a run through of some of the strategies I've mentioned today for preserving capital in retirement, I produced this video a while ago. I'd recommend watching this one next to give you a better understanding of those concepts and how they could help you. I hope that's been useful, and I'll see you again soon.